The Treasury Department just did something it hasn't done in modern memory. And gold responded with a 4% surge in a single session, its biggest one-day move in over a year. But here's where it gets interesting. After hitting $4,540, gold pulled back to $4,509. Silver surged over 1.7% to test $68.18. And now traders are asking the same question I'm asking. Is this the beginning of a sustained rally, or are we looking at a classic buy the rumor, sell the news reversal? Let me be clear about what happened. On Wednesday, Treasury Secretary Scott Bessent announced the Treasury would at least double its buybacks of longer-dated securities from $2 billion per operation to at least $4 billion per operation. The 30-year yield had topped 5.3%, its highest level in nearly 2 decades. The national debt just crossed $40 trillion for the first time ever. And Bessent, who calls himself America's top bond salesman, panicked. The result? The dollar plunged. Yields collapsed. And gold, the ultimate anti-dollar, anti-debt asset, exploded higher. I've seen this playbook before. When a government starts buying its own bonds to suppress yields, it's essentially admitting it can't afford higher interest rates on its debt. And that's when hard assets like gold and silver become the only game in town. But here's the catch. We've also got Flash PMIs dropping today, and the Fed minutes from Wednesday showed a surprisingly hawkish tone. 3 dissents for a hike. Broader support for tightening then. The 9-3 vote suggested, what stands out to me is not the headline buyback number. $4 billion is a rounding error in a $40 trillion debt market. What matters is the signal. The Treasury is telling markets it will intervene in the 10 to 30-year part of the curve. I've seen this exact dynamic play out twice in my career, once during the 2019 repo crisis and again in 2023 with the debt ceiling drama. Both times, gold rallied hard, then corrected, then rallied again. The question is timing, not direction. Here's my bottom line for today's session on gold. XAU USD, I am ** bullish above $4,450 **, neutral between $4,450 and $4,500, and watching $4,540 as the key resistance. Gold is currently trading around $4,516 after pulling back from Wednesday's highs. The 200-day SMA sits at $4,512 and is acting as pivotal support. My invalidation level is a daily close below $4,450. That would open a path to $4,400 and potentially $4,300 on silver. XAU USD, I am bullish but cautious above $65.64. Silver is trading at $68.18, testing the 100-day SMA at $68.51. The RSI is approaching overbought territory. A break above $68.51 opens the door to $70, and then the 200-day SMA at $71.97. Below $65.64, support sits at $62.19, the August 19th swing low, and then the 50-day SMA at $61.35. Here's my question. Are you buying this dip, or do you think gold has topped out at $4,540? Drop your view in the comments. I want to see where the community stands. Let me walk you through the charts starting from the weekly time frame and drilling down. Weekly chart. Gold has printed 4 bullish weeks out of the last 5. The rally out of a 7-week consolidation at the yearly lows has now run the market straight into a lateral zone where 3 measures converge: a Fibonacci retracement, the 200-day moving average, and a prior high close. This is a critical inflection point. The weekly RSI is at 63.78, bullish but not yet overbought. The MACD is showing a bullish crossover that's gaining momentum. The ATR, 14, is at 18.23, indicating elevated volatility. Daily chart. This is where the story gets fascinating. Gold has broken above the 200-day SMA at $4,512. More importantly, XAU USD broke a 5-month-old downward resistance trendline drawn from all-time highs near $5,600. That's a significant structural break. The daily RSI is at 63.78, pulling back from overbought but still bullish. The MACD, 1226, is at 22.79 and firmly in buy territory. The ADX, 14, at 34.38 confirms a strong trend. The break of that 5-month trend line from the all-time highs is the kind of technical event that gets my attention. I've seen similar breaks 3 times in my career, in 2020, in 2022, and in 2024. Each time, the initial breakout was followed by a pullback to retest the broken trend line, and then a sustained move higher. The 200-day SMA at $4,512 is that retest level right now. If it holds, we are looking at $4,595, then $4,600, then $4,700. 700.4-hour chart. On the 4-hour, we are seeing a clear pullback from the $4,540 high. The RSI has dropped from overbought levels to around 63, suggesting the overbought condition has been worked off. The MACD on the 4-hour is still bullish but showing signs of slowing momentum. Key support on the 4-hour is $4,500, psychological, then $4,480, then $4,450.1-hour chart. On the 1-hour, we are seeing a consolidation pattern forming between $4,500 and $4,525. The RSI is neutral at 55 to 60, suggesting indecision. A break above $4,525 could trigger a move back towards $4,540, while a break below $4,500 would target $4,480 and then $4,450. Now, if you think gold is the only story here, you're missing half the picture. Silver is actually showing more momentum right now, and that's where the real opportunity might be. Weekly chart. Silver has surged to its highest level in 2 months, trading at $68.18. The weekly RSI is approaching 70, bullish territory. The pair has gained over 18% in the last 4 weeks. The weekly MACD is showing a strong bullish crossover. Silver is outperforming gold, which is a classic sign of a risk-on environment in the precious metals complex. Daily chart. Silver is testing the 100-day SMA at $68.51. This is the key technical level for today. The daily RSI is above 50 and approaching overbought territory. The MACD is showing bullish momentum. The stochastic, 9/6, is at 78.43, indicating bullish momentum but nearing overbought. If silver can reclaim the 100-day SMA, the next resistance is the psychological $70 level, followed by the 200-day SMA at $71.97. Above that, $75 becomes the next area of interest. 4-hour chart. On the 4-hour, silver has formed a series of higher highs and higher lows since the $62.19 low on August 19th. The RSI is at 65 to 70, bullish but not yet extreme. The MACD is showing a bullish crossover that's gaining momentum. Support on the 4-hour is at $67.50, then $66.50, then $65.64.1-hour chart. On the 1-hour, we are seeing a consolidation near the highs. The RSI is at 60 to 65, bullish but showing some loss of momentum. A break above $68.50 would trigger a move towards $69 and then $70. A break below $67.50 would target $66.50. Now let me connect the dots on what's really driving these moves, because the headline story is only half the picture. The Treasury Buyback bombshell, the primary catalyst for this week's precious metal surge, was not the FOMC minutes. It was the Treasury's announcement that it would double its long-dated buyback operations. Treasury Secretary Scott Bessent said in a CNBC interview that the government might increase repurchases beyond $4 billion per issue. This is effectively yield curve control adjacent. The Treasury is increasing official purchases in the part of the curve that has been hit hardest by worries about deficits, inflation, and massive government borrowing. The 30-year yield topped 5.3% this week, its highest level in nearly 2 decades. Average mortgage rates are creeping back towards 7%. And the US national debt just crossed $40 trillion for the first time ever, more than 120% of GDP. When the Treasury buys long-dated bonds, it becomes an additional buyer in that market, supporting bond prices and putting downward pressure on long-term yields. Lower yields reduce the opportunity cost of holding non-yielding assets like gold and silver. The dollar plunges. And hard assets surge. Gold and silver added a combined $1.3 trillion in market cap after the Treasury's announcement. That's not a small move. That's a paradigm shift. The FOMC minutes, what they actually said. The July FOMC minutes showed a much more hawkish stance than the 9-3 vote suggested. 3 members voted for a 25 basis point hike. More importantly, the minutes showed that several officials remained open to further rate hikes if inflation remains high. But here's the thing, the market is forward-looking. Money markets have priced in a 67.4% chance that the Fed will hold rates unchanged in September. The hawkish minutes were old news. The Treasury buyback news was new. That's why gold surged despite the hawkish signals. Today's catalyst, Flash PMIs. Today's economic calendar features S&P Global Flash PMIs for the Eurozone, UK, and US. These will be critical for gauging the health of the global economy. If the data shows economic slowdown, it would reinforce expectations of lower rates, bullish for gold and silver. If the data surprises to the upside, it could strengthen the dollar and weigh on precious metals. The inflation story, oil. Prices have extended their rally to a more than 3-week high as stalled talks over the Iran conflict sustain market concerns about Middle East supply disruptions. Higher oil prices revive inflation concerns. And inflation concerns, paradoxically, are both bullish and bearish for gold. Bullish because gold is an inflation hedge. Bearish because higher inflation could force the Fed to hike rates. Morgan Stanley sees scope for gold to exceed $5,000 per ounce in 2027, potentially earlier. But they also note there's scope for volatility. Here's what I want to know. Are you trading the Treasury buyback story, or are you fading this precious metals move? Let me know in the comments below. Now let me give you the setups I'm actually watching today. Remember, these are my personal levels. Your risk tolerance and account size may differ. Always manage your own risk. Scalp setup 1, gold long, support bounce, trigger. Buy on a bounce from $4,500 to $4,505 with bullish reversal confirmation, hammer candle or bullish engulfing on the 5-minute. Entry, $4,503 stop loss, $4,488, 15 points, take profit 1, $4,525. 22 points, take profit 2, $4,540, 37 points, R&R, 1.47 to 1 on TP1, 2.47 to 1 on TP2 invalidation. Daily close below $4,450. Why this setup? $4,500 is a psychological support level and the 200-day SMA is at $4,512. We've seen strong buying interest at these levels. A pullback to $4,500 offers a low-risk entry with tight stops. Scalp setup 2, gold short, breakout failure, trigger, sell on A. Rejection from $4,535 to $4,540 with bearish reversal confirmation, shooting star or bearish engulfing on the 15-minute. Entry, $4,538 stop loss, $4,553, 15 points, take profit 1. $4,520, 18 points, take profit 2, $4,505, 33 points, R&R, 1.2 to 1 on TP1, 2.2 to 1 on TP2 invalidation, close above $4,555. Why this setup? $4,540 was Wednesday's high and a key resistance level. The daily momentum has been diverging into the most recent high. If gold fails to break this level, a short scalp offers a favorable risk-reward. Swing setup, gold long, breakout continuation, trigger. Buy on a daily close above $4,550 with bullish momentum, MACD bullish crossover confirmed, RSI above 60. Entry, $4,555, market order on daily close above $4,550, stop loss, $4,450, 105 points, take profit 1, $4,595, 40 points, May 20th daily high take profit 2, $4,700, 145 points, R&R, 0.38 to 1 on TP1, 1.38 to 1 on TP2 invalidation, daily close below $4,450. This setup, if gold can close above $4,550, it breaks the recent consolidation and opens the door to a move towards $4,595 and potentially $4,700. The fundamental backdrop, Treasury buyback suppressing yields, dollar weakness, inflation concerns, supports further upside. Now, if you're more interested in silver, stick with me because the setups on silver are actually more compelling right now. Scalp setup 1, silver long, 100-day SMA breakout, trigger, buy on a break above $68.51, 100-day SMA, with bullish confirmation, strong green candle on the 15-minute. Entry, $68.55 stop loss, $68.05, 50 cents, take profit 1, $69.50, 95 cents, take profit 2, $70, $1.45, R&R, 1.9 to 1 on TP1, 2.9 to 1 on TP2 invalidation, close below $67.50. Why this setup? Silver is testing the 100-day SMA at $68.51. A break above this level would confirm bullish momentum and open the door to $70, and then the 200-day SMA at $71.97. The RSI remains bullish above 50. Scalp setup 2, silver short, rejection from 100-day SMA, trigger, sell on a rejection from $68.50 to $68.60 with bearish reversal confirmation entry, $68.55 stop loss, $68.90, 35 cents, take profit 1, $68, 55 cents, take profit 2, $67.50, $1.05, R&R, 1.57 to 1 on TP1, 3 to 1 on TP2 invalidation, close above $69.00. Why this setup? The 100-day SMA at $68.51 is a significant resistance level. If silver fails to break this level, a short scalp back towards $67.50 offers a favorable risk-reward. The RSI is approaching overbought territory, suggesting a potential pullback. Swing setup, silver long, breakout continuation, trigger, buy on a daily close above $69 with bullish momentum entry, $69.05, market order on daily close above $69, stop loss, $65.64, $3.41, take profit 1, $70, 95 cents, take profit 2, $71.97, $2.92, 200-day SMA R&R, 0.28 to 1 on TP1, 0.86 to 1 on TP2 invalidation. Daily close below $65.64. Why this setup? If silver can close above $69, it confirms a break above the 100-day SMA and opens the door to a move towards $70, and then the 200-day SMA at $71.97. The fundamental story. Treasury buybacks, dollar weakness, strong industrial demand from China, supports further upside. Let me take 30 seconds to talk about something that matters more than any setup I've just given you, risk management. The market is in a volatile regime right now. We've got Treasury buybacks, hawkish FOMC minutes, Middle East tensions, and Flash PMIs dropping today. Gold just had a 4% move in a single session. Silver is up over 18% in 4 weeks. This is not a market where you want to be aggressively leveraged. My rule for this environment. Position size at 50% of normal. If you usually risk 1% per trade, risk 0.5%. Give yourself room to be wrong. The setups I've given you have tight stops on the scalps, 15 points on gold, 35 to 50 cents on silver, which means you can get stopped out quickly if the market whipsaws. That's fine. That's the cost of doing business. What you don't want is to get caught in a 50-point move against you with too much size. I learned this lesson the hard way back in August 2020, during the COVID rally. Gold was on a tear, I was convinced it would keep going, and I sized up aggressively. Then the market pulled back 80 points in a single session and I got stopped out at the exact bottom. I was right on direction, wrong on timing, and my account paid the price. Since then, I've never traded a volatile environment with full size. Size down, stay in the game. One more thing, watch the gold-silver ratio. It's currently around 66, 4,516 68.18. A falling ratio suggests silver is outperforming gold, which is typically bullish for the entire precious metals complex. If the ratio drops below 65, expect silver to continue its outperformance. Let me wrap this up with the key levels you need to have on your screen. For gold, support at $4,500, $4,480, and $4,450. Resistance at $4,525, $4,540, and $4,595. The bias is bullish above $4,450, bearish below $4,450. The 200-day SMA at $4,512 is the line in the sand. For silver, support at $67.50, $66.50, and $65.64. Resistance at $68.51, 100-day SMA, $70, and $71.97, 200-day SMA. The bias is bullish above $65.64, bearish below. The big picture is this: the Treasury buyback story is the dominant driver right now. As long as the Treasury is aggressively buying back long-dated debt, yields will be capped, the dollar will struggle, and precious metals will find support. But don't get complacent, the Fed is still hawkish underneath, and today's Flash PMIs could shift sentiment quickly. The next major event to watch is Jackson Hole next week, where Chair Warsh will make his debut. That could be a major market mover. Before you go, drop your gold and silver levels in the comments. Where are you looking to enter? Where are you placing your stops? Let's build a community of traders who actually share their thinking, not just the usual emoji spam. This is Trade Meridian Decoded signing off. Trade smart, manage your risk, and I'll see you in the next one.